Term? Whole life? Universal? Let's dig into it. Hello everybody, Joe Werbick coming at you. Today we are going to talk about life insurance. So what is life insurance? Life insurance is an agreement between you and an insurance company. And that agreement says that if I die while this policy is in force, it is up to the insurance company to pay my beneficiaries a certain amount of money, an agreed upon amount of money. That is the death benefit. You can choose the death benefit up front depending upon the type of policy, and we'll get into different types of policies here in a few minutes. But basically, let's say you buy a $100,000 death benefit, okay? And let's say a few years into having the life insurance, you pass. What should happen at that point is your beneficiaries would deliver a death certificate to the insurance company. They'd fill out claim forms, and the insurance company would be on the hook for that $100,000. And the beautiful thing about life insurance is if it's done properly, that whole $100,000 should be federally tax-free, it should be state tax-free, it should be local tax-free. Basically, that life insurance will go to your beneficiaries 100% tax-free. That's the beauty of life insurance. So if you've watched my other videos and you've seen about IRAs or other assets, when you die, those assets could be taxable to your heirs. Life insurance, if done correctly, is 100% tax-free. And when I say done correctly, what do I mean by that? Basically, as long as the life insurance policy is not so large that it pushes you into the federal estate tax bracket, which currently is around $20 million. So as long as you're buying less than $20 million of life insurance, you should be fine, and that whole amount of money should go to your heirs 100% tax-free. And how do you know how much coverage you need? Well, a rule of thumb may be 10 times your income. So if you're making $50,000 a year, you may want to just simply get $500,000 of coverage. Now, it's important that you sit down with a qualified individual. I don't always recommend that you sit down with a life insurance agent. Life insurance agents are really good at selling life insurance, but they're not always good at selling the right life insurance for the right individual at the right time. Once again, I'm going to recommend sit down with a certified financial planner, a CFP. While CFPs may not be life insurance agents and they may not even be licensed to sell life insurance, they can help you understand what type of life insurance you should buy, how much you need. It's important that you understand that because you don't want to become what they call insurance poor, where you're spending all this money to buy life insurance and you can't even afford your daily expenses. So it's important that you sit down with a qualified individual to come up with the right amount of life insurance and the right type of life insurance. We have term insurance, we have whole life insurance, and we have universal life insurance. And each of these policies have pros and cons. One isn't necessarily better than the other. So let's talk about term insurance. What is term life insurance? It's basic, it's easy. It's a term. You will pick how long you want that term to be. Do you want it to be 10 years? Do you want it to be 20 years? Would you like it 30 years? And that basically is saying how long the policy will be in force. Now, there are two different types of term insurance. There's level term insurance and there's increasing term insurance. Most of the time, if you get term insurance at your work, it's going to be of the increasing variety. And what that means is you'll be covered as long as you're working, but each and every year that premium is going to increase. If you buy term insurance on your own, it's probably going to be level insurance. So you pick the amount of time you want it to be level. Do you want it to be level for 10 years? That means that you're going to pay the same price each and every year for that 10-year period. Now, what happens at the end of the 10 years? The insurance company is still going to be willing to cover you for as long as you wish, but at the end of the 10 years, that premium is going to skyrocket. I mean, it is going to increase. I've seen some of these premiums go from $1,000 a year to $50,000 a year. Why? Because the insurance company thinks at that point you're too much of a risk. See, what they've done is they've looked at you, looked at your age, looked at your health, and said, okay, we feel this individual more than likely will not die over the next 10 years, so we're willing to sell them very inexpensive or very cheap life insurance. I need you to understand that term insurance is not permanent. the policy more than likely will not be in place on the day you die. And the most important thing about life insurance, listen to this, is very important, is that the policy is in force on the day you die. Because why else are you buying the policy? You're buying it to protect your loved ones. You're buying it so when you die, there's a death benefit that gets paid out. Now, something else to consider about term insurance is what if the policy expires, meaning what if you get to the end of that 10 or 20-year period and you still need more insurance? It depends on whether or not you're healthy enough to get it, because one of the prerequisites of life insurance is that you have a certain level of health to qualify. So let's say I'm 40 years old and I buy a 20-year term policy and I get to age 60 and I still feel like I need life insurance, but my health has changed. I may not qualify for life insurance beyond age 60 because I'm not healthy anymore. And because I said at the end of that term, the cost of the insurance could go through the roof and it doesn't make financial sense for me to keep the term policy. So if you feel that you need a life insurance policy for a longer period of time, term insurance may not be your best option. Term insurance is good for young couples. Say you just got married, you have a lot of expenses, you want to make sure that if you die, your spouse is taken care of, your kids are taken care of. Awesome. Term insurance does a great job of that, and for a few $100s a year, you may be able to get hundreds of thousands of dollars of coverage that'll protect your spouse, protect your kids should you die early. So that's term insurance. What's next on the list? Let's talk about whole life insurance. And whole life insurance does a good job of explaining what it's meant to do. It's meant to cover you for your whole life. So it's basically in place to say, I will have this policy until the day I die. Now, most of these policies endow at a certain age. And what does endow mean? Endow means you've made it beyond the life expectancy of the insurance company. And so what they're going to do at that point is just give you back your money. So a lot of whole life insurance policies will endow at age 100, maybe age 110. And that means if you live to that age, they basically said, okay, you win. Here's the money that you gave us. We're going to pay it back to you and you're going to go on your way, which isn't necessarily a good thing because that could be a taxable distribution if you actually make it there. So whole life insurance guarantees two different benefits. It guarantees your death benefit and it guarantees your cash value. And because all of the risk is on the insurance company and they have to guarantee two areas instead of just one, like term insurance that just guarantees a death benefit, and they guarantee that death benefit for a very short period of time, whole life insurance is going to be the most costly, the most expensive of all the life insurances we're going to talk about. But if you like the idea that you're going to have no questions, I know my death benefit is guaranteed for my entire life, I know that my cash value is guaranteed, you may want to look into whole life insurance and see what the cost is going to be. So the way it works is you're going to pay a higher premium for whole life insurance than what you were paying for term insurance, and that premium is actually going to be higher than what the actual COI is. COI is very important to understand. COI stands for cost of insurance. So when you buy a whole life insurance policy, immediately you're going to pay a higher cost of insurance than what you would pay for term insurance, because all of those extra premiums are going to be taken by the whole life insurance company. They're going to be invested in their coffers, okay? And then they're going to return that to you through dividends throughout the life of the policy. And so you're going to cross a point if you live long enough. Maybe it's going to be 60, maybe it's going to be 70, where the premium you're paying in is now actually lower than the cost of insurance, but because you overpaid for all of those years, they're going to give you those dividends back, and that's going to cover the shortfall if you continue living beyond that point. So that's whole life insurance. Again, it covers two benefits. It covers your death benefit, and it guarantees a certain amount of cash. So we talked about term insurance, we talked about whole life insurance. Now let's talk about universal life insurance. And universal can be structured more like a term policy, and it can be structured more like a whole life policy, and you get to decide what you want. Are you looking for a life insurance policy that guarantees you up until a certain age, say 65, 75, 80? Are you looking for a life insurance policy that guarantees you, say, to 115 or 120 for your whole life? You get to create that. So again, it's important that you work with somebody who understands how these policies work so you can tell them what you're looking for. Now, when I build out universal life insurance, I'm looking either for a death benefit, or I'm looking for cash value, or I'm looking for something in between, and that's going to tell me what type of policy I'm going to offer to my clients. Universal life insurance is a lot like whole life insurance in that when you begin paying into it, your premiums are going to be higher than your cost of insurance. They won't be as high as they are in whole life because all of the risk is not on the insurance company's side. So because you're paying in excess premiums above what your cost of insurance is, it'll be up to you how those excess premiums are invested. So you can choose to buy a fixed universal life insurance policy or a variable universal life insurance policy. If you choose a variable universal life insurance policy, it is going to be up to you to pick the investments. It is going to be up to you to manage those investments, and you are shouldering all of the risk that those investments do well and they don't tank, because if those investments tank and you lose your cash value, your life insurance policy can disappear. So if you're willing to take that risk, if you're willing to, actively manage the portfolio yourself, look at that and make sure it works, variable universal life insurance may be an attractive option for you. I don't like variable universal life insurance personally as a CFP. I don't point my clients down that road because I feel like we're taking too much risk in terms of the markets have to perform and the insurance company has to perform in order for that policy to be guaranteed for your life. I tend to lean more on the fixed or the fixed indexed universal life policies, and those policies afford my clients the opportunity to take advantage of some of the upside of the market, but not worry about the downside of the markets where they're going to lose money if the markets fall apart. So if you're looking for a life insurance policy that's going to guarantee you for a certain amount of years, not the short period of time like term, but more of a long period of time. Maybe you want to guarantee it till 90 or 95, and you don't care about the cash value. All you care about is that on the day you die, there's a big fat death benefit that goes to your heirs. Then traditional fixed universal life, guaranteed universal life is where you want to look. If, on the other hand, you're looking for a policy that you can get a death benefit and some cash value, meaning you have access to the cash at some point in time, maybe you can pull some of that cash out, then indexed universal life insurance might be the path you want to pursue and look down, because that can guarantee you both the death benefit for a certain number of years and can offer you upside in the market without the variable risk of a variable universal life insurance policy. Again, it's so important that you find a qualified advisor. That's why I like to recommend CFPs in this area to help you navigate through these waters, because you can see term can be right at some points in your life, whole life insurance might be right, universal life insurance might be right. And if you watched my videos on long-term care and chronic illness, you'll know that a lot of these life insurance policies offer not only the death benefit, but they also offer chronic illness riders. So now you have to think about, do I want just the death benefit? Do I want the death benefit and the chronic illness rider? Do I want the death benefit, the chronic illness rider, and the cash? And you can see how it can get confusing to the average consumer. So please sit down with a qualified advisor. At the end of the day, life insurance all comes back to COI, the cost of insurance. You really need to understand the cost. What is it costing you to buy this policy? So when you talk to the CFP, if you talk to the life insurance agent, ask them, what is my actual cost? I'm putting this money into this policy. Does it have upfront fees? Does it have back-end surrender charge fees? Is it, what are my actual ongoing costs with this policy? So you get a good understanding and you can compare apples to apples. Because when you look at a whole life insurance policy and you compare it to a variable universal life insurance policy, to a guaranteed universal life insurance policy, you need to know what you're looking at in order to make an informed decision. And that's why I go back to making sure you have the proper advisor who can help you navigate these choppy waters, because life insurance is not as simple as it sounds on the surface, but it's important that you understand this, because the last thing you want to do is die without any protection. You want to make sure that you have the right amount of death benefit at the right period in your life. So that means for some people it's going to be term insurance, for some people it's going to be whole life insurance, for some people it's going to be universal life insurance. And I do not buy into the idea of buy term and invest the difference. That does not work for long term, because if your health changes, you're not going to get covered anymore. So it's a really good idea to get the right life insurance for you at the right point in time and have it guarantee you as long as you need it to guarantee you. I personally, I'll just let you know, I have some term insurance. I have some universal life insurance. I don't just have one. I have certain policies to cover certain risks in my life, and I have different policies to cover different risks, and then I have a different policy to cover my long-term care needs. So it's not a simple, straightforward solution. That's why I created this video. Hopefully, this video educated you and didn't confuse you even more. But if you have questions, please reach out to us. It's my job to help you understand this and to point you in the right direction. As always, if you like this video, make sure you hit like. If you have comments, please reach out to us. If you have questions, let us know what we can do to help you better understand how to protect yourself, protect your loved ones. Thank you, and I'll see you on the next video.